The cap rate or capitalization rate. And for those who are not familiar with real estate, it's a common term that describes non-levered rate of return on deployed capital. So if you have $800,000 worth of income and you bought a property for $10 million, that's 800,000 divided by 10 million, that's 8% per year capitalization rate. So as interest rates rose.
Welcome to the Executive Connect podcast. I've got Mr. Mike Zlotnik here today to talk to us a little bit about real estate and portfolio construction. Appreciate you joining the show, Mike.
Thanks, Bryan. Thanks for having me.
So a lot of investors chase individual deals, Mike, but you kind of emphasize portfolio construction. Can you talk to us a little bit about why?
Sure. So let's start with the general theory. I always say, don't chase deals, work with people. So especially in real estate. Investing is a little different if you're operating in the stock markets, but you're still following leaders. You're still working with people. So the most important thing in my book is to check ahead of the horse, who you're working with, who you're investing with. That's the step number one. Then obviously composition of deals, and then negotiations of terms. But if you look at the portfolio holistically, I believe in some of these really basic principles, like Ray Dalio's 10, 12 non-correlated investments. There are other portfolio composition theories, but the basic theory is, of course, they have to align with your overall goals. So you got to start, obviously, with your long-term risk tolerance, what you're looking to invest in terms of time horizon, the type of income you need, the liquidity you need, obviously how much leverage you want to take, some other really basic questions that you should ask yourself to better understand what you're looking for first. So once you have your own goals, you can compose a portfolio to match that. And portfolios obviously need to be composed with a mix of liquid and some illiquid investments. We all do that, right? Liquid investments are generally publicly traded securities, stocks, bonds, funds that are publicly traded. And then you also have opportunities of the private investment world, alternatives. I primarily play in the alternatives. I primarily play in real estate. I understand that really well, and real estate is generally inherently illiquid. So depending on your overall portfolio needs and the diversification, real estate could play an important role. And where it plays a really great role is real estate is generally a form of investment that has phenomenal tax benefits. It has opportunity to leverage the investment. It's got amortization, appreciation, depreciation, cash flow. Many things is difficult to achieve in stock market. For example, average yield on S&P 500 today is 1.2%. It's almost insanely how low it is. So if you're looking for income, it's very difficult to achieve in stocks. But you have much better capability and options to create an income portfolio in real estate. Depreciation is a unique tax benefit that, especially now with the bonus depreciation being where it is at 100%, you could really enjoy phenomenal passive loss from depreciation and have years worth of tax shielded cash flow in real estate. I'm going to stop for a second and let you kind of ask any more questions, but it's portfolio composition needs to have multiple strategies. As I said, liquid, illiquid, real estate plays a role. I don't claim to be a portfolio composition expert across the entire spectrum, but in real estate, we can talk about what diversified portfolio looks like. We can talk about how you can compose income.
Ready to lead smarter and invest wiser? On the Executive Connect podcast, we unpack executive strategies for wealth and influence. Hit the subscribe button now. Don't just watch, act.
Yeah, I think a lot of folks have been through their MBA program, and sort of like the holy grail is like the non-correlated assets, right? And really what matters is the covariance of returns for the overall portfolio. So that's one of the things that I guess if you buy real estate the right way is people profess that they are somewhat non-correlated, even though they probably are in some ways, depending on what the risks are that you're talking about. So can you talk a little bit about that? And I know that folks also really love real estate because of the leverage, but the leverage does obviously split both ways as well. And the fact that there are opportunities to purchase out of distress a lot of times because they are non-liquid, that presents some unique opportunities if folks do have cash available. But I think one of the things I always think about is the cash is also not working to be able to, to produce that opportunity to purchase at a certain place. Now you can get things like lines of credit and stuff like that to be able to access things and leverage your balance sheet and stuff like that. So I guess just in general, how should people be thinking about this as an asset class? Is it sort of an opportunistic thing, or do you really think of it more in terms of something that's income producing, so that you can ride out these times where maybe it's not the optimal time to sell?
So from a market cycle perspective, now probably is one of the best time to enter the market, especially commercial real estate. We've seen a significant reset when the interest rate spiked, when the Fed hiked fast and furious and kept interest rates higher for longer. They basically dislocated private equity, and they've also dislocated commercial real estate. There's been a reset, a significant reset. So if you think about it, it's really difficult to see better time than now. We don't know if we're exactly at the bottom. We could be already on the recovery path or somewhere near the bottom, and likely are going to see recovery very soon. And why I say that is it's just look at the direction of interest rates. Real estate trades on leverage, and the interest rates were elevated, kept at an elevated level. There were some cuts last year, but they were small and not enough. And now the Fed restarted the rate cutting cycle, and a lot of opportunities, because real estate is in an inefficient market. Public markets are generally very efficient, real estate inefficient. Phenomenal deals could be found for motivated seller situations, quality assets, but distressed motivated sellers, financially pressed. So one person's difficulty is another person's opportunity. And unfortunately, or maybe fortunately, in real estate, this is how it works. So we're seeing phenomenal deal flow today. The cap rate or capitalization rates, and for those who are not familiar with real estate, it's a common term that describes non-levered rate of return on deployed capital. So if you have $800,000 worth of income and you bought a property for $10 million, that's 800,000 divided by 10 million. That's 8% per year capitalization rate. So as interest rates rose, cap rates rose and values fell. I mean, they move in the opposite direction, cap rates and the values, because you pay for the same level of income more or less as a matter of a price. So today we find ourselves where the cap rates are high, prices are low, cash flows have improved, fundamentals look phenomenal in many aspects, and we're just going to cover some really basic fundamentals of investing in real estate. So obviously, one of the simplest way to look at this, if you can buy properties at an 8% cap rate, as an example, and finance with a mortgage at 6%, that positive leverage magnifies cash flow, because you're getting non-levered 8, you're leveraging with 6, you're improving cash flow. It's also a margin of safety. On the other side, you see prices significantly below reconstruction cost. It's another way to look at the how well of a deal you're getting today. Is if the owner is distressed, they can't get the price they want. There are very few buyers, and those with cash make the rules. And the bidding is, so let's just call it a little bit of vulture investing. I don't want to make it sound too negative, but when you're getting these great deals, it feels like you are getting, a little bit of that. So below reconstruction cost, we see deals below 50% of the reconstruction value for quality assets. Also, is another interesting factor, and that's simply how much discount off the peak of the market you're getting today. The market saw the peak in 21, 22. Let's use the 2022 as the peak. A lot of the properties trade today at a discount 20 to 40% off the peak. So you don't know exactly how much discount you're getting on the as-is basis because the volume of trades is very limited. But you can get phenomenal deals relative to what properties were, relative on a cash flow basis, relative to basically intrinsic value. So the price you're paying relative to intrinsic value is really great. And reconstruction is a very relevant point, is that the new construction has also slowed down quite a bit because of a higher level of interest rates. So the new construction, you can't get a discounted cost to build what it costs to build. So the new projects are much more difficult to justify, while the existing ones you can buy at a great price point. And you lever all that with an income strategy as an example. Can you still get these deals today and where you don't take a lot of risk, right? So the risk can also be looked at what kind of real estate you're acquiring and what is the complexity of operation. So if you're acquiring real estate, that is just an example of industrial real estate with an absolute triple net lease where the tenant pays for everything, every type of increase in cost, taxes, insurance, the new capex, the roof, the pavement, it's all tenant's responsibility. So if you can get into those kind of deals, they become very, very predictable. They almost act as a cash flow bond. They pay almost like a bond because the long lease with the high credit quality tenant makes a very predictable cash flows. And quite often these leases have rent escalation clauses, so the cash flow is growing every year. And then the value is forced because you're growing NOI. It's just an example of how you could be very programmatic. You get cash flow today, you get a cash flow growth, you get a growth of value because the NOI is growing every year. And then if the interest rates come down, you're going to get all kinds of tailwind because the cap rates will come down too. So suddenly, not only you're buying deep today, and you're not really speculating where things are going to go, you're expecting certain rates of return. But if the cap rates compress with low interest rates, you're going to get tailwind. And I feel that multiple strategies like open air shopping, industrial, some multifamily deals could be very, very attractive on a relative basis, but you got to buy the right type of property. And today we look for simplicity. We don't want difficult, complex projects with heavy lift, a lot of redevelopment, a lot of operating complexity. It's a matter of taste. You can get involved with heavy lifts. It's just you can find great values without the heavy lift. Why get involved with the heavy lift?
Yeah, well, no, that's certainly a sign of the times now, right? Like it's if you're buying at the right time, you don't necessarily have to force appreciation very much. It's just a matter of being liquid when it's opportunistic to be liquid, buying a illiquid investment. So that makes a lot of sense. I think a lot of our
And you got to have
viewers.
courage. Yeah, I just want to add one point. So today we find ourselves, I don't know when the episode is going to get released, but the markets have done really, really well, public markets. The Mag 7 or the entire markets are doing very, very well. So there's significant complacency and people don't necessarily know if the bull run is going to end or going to continue. But the signs of, in my view, the signs of market overvaluation, although I don't know any better than you do, markets could continue to march forward, and AI investments can continue to do that. But Ray Dalio recently, in a recent interview, said it reminds him like 1999, 1998 dot-com boom, where everybody thought it was changing the world, and it was. And people were paying insane valuations for all these technology stocks, and the markets were elevated because of these wonderful tech companies. And then the markets went through a significant reset. So to me, you got to have courage and conviction and desire to diversify, to take some chips off that table and move it into what's not really popular today. It's almost a contrarian play, and move it into commercial real estate deals with the folks, of course, that you know, like, and trust and get comfortable investing with. But it feels like the return profile in commercial real estate on a forward basis will be much more attractive relative to many other strategies because it has gone through a cycle while have other markets at the peak of the cycle. So it's almost the non-correlated investment is they're experiencing the opposite side of a market cycle. Stocks are at the peak of the cycle or local peak, while commercial real estate is at the local bottom of the market cycle. And we're about to start the recovery, in a manner of speaking.
Yeah, and I think that for a lot of our viewers, I mean, they're not probably off sourcing lots of different deal types, and even people that are great at this, they tend to specialize in one or two different types of assets. So, I mean, what would you recommend for folks that are looking to invest through either an operator or a sponsor or something like that? Picking the right asset class is one thing. Picking the right jockey for the horse is another thing. how should they be thinking about that?
Money Ripples is on a mission to help professionals just like you get their money working harder for you. Their clients free up an average of $35,000 their very first year without having to work extra hours. To show you how, they've put together a powerful training called Cash Flow Secrets, and the listeners of the Executive Connect podcast can get it completely free. Just visit moneyripples.com/secrets and enter the promo code EXEC.
Sure. So it's a great question. We certainly, again, we run a model. We are not direct operators. We are investors in our heart. We call one term I use is capital partners. Another term I use, we marry money and opportunity. And at the end of the day, when we invest, and most investors should think the same way, who are you investing with, and how do you evaluate their team, their capability, how long they've been around, what do they like, how they think, right? To me, it's more important to understand how they feel, how they think, how they function. Obviously, there's mechanical things like reporting, updates. You want to invest with people who are pretty good on all levels, right? You can invest a check and they're a good operator, but the reporting stinks, right? And you're going to be chasing them to get a report. All those things matter. So it's not a one question, but you definitely got to get a feeling of who you're investing with, what they're investing into. You have to understand how they make money. What bothers me most is when people invest without understanding how the business they invest in or real estate project that they invest into or whatever the strategy makes money. They're investing in a black box. You shouldn't be investing in a white box. It should be pretty clear, obviously, if it's a good jockey, but what asset? Where is this asset located? What type of a tenant it has? Especially industrial. You can actually ask these questions. You can dig into the asset itself. What location? Is this, business-friendly environment? Is this, if you're investing in residential in New York City, is this subject to rent control? So you got to know some of the local dynamics as an example. But some folks prefer to invest in, areas where the governments are more pro-business, pro-friendly versus some of the more difficult environments. And we do the same thing. So again, you start vetting who you're investing with. There are many ways to do this, but at minimum, spend some time chatting with them. If you're going to write a significant check, obviously meet up on Zoom a few times, maybe even try to meet them in person. I like to meet people. I've never gotten a check from anyone that I have not spent time with, at least talking to, understanding what they're looking for. I don't need a check ever from somebody who wants to invest into what we don't want to do. If you tell me you want to invest, you have a lot of money and want to invest in ground up, I'm going to tell you, have a nice day. I can't help you at all. But if you're looking for income-oriented, more defensive strategies today, happy to chat. And then, besides the jockey, you got to go look at the deals. A lot of deals today, you can convincingly, mathematically, and anecdotally get very, very comfortable with the area, with location. Obviously, underwriting with pro formas and all the paper underwriting is wonderful, but at the same time, go to that area. If you're going to write a big check, if you're writing a small check, maybe it's not worth the trip. But if you're writing a big check, definitely fly out and take a look. We try to go to the assets and get an understanding what local dynamics look like. There's nothing like driving around and getting a feeling what the neighborhood looks like. Is this in a path of progress? Is this already in a good area? Just kind of getting some idea of local dynamics, sort of basic thinking through. And then the last thing that I'll say, which is really important, we always have three. So obviously, who you're investing with, what are you investing into? And the third piece is terms, right? You can have a wonderful 1 and 2, great jockey, great horse, but the terms you're getting are not necessarily great terms. So there's plenty of people I've seen offer mom and pop terms, I call them, versus institutional quality terms. So in real estate, it's a good pref at a good split. Could be 8 pref, 80-20 split as an example. I've seen people offer 7 pref and 50-50 split. So example, again, these are pretty basic terms, but understanding what happens in a good case scenario, you got to be generating a lion's share of the upside, while the people who you're investing with are not doing volunteer work. They need to have motivation to be able to find the deal and run the deal. So it's a mix of what's a fair mix. But in this environment, there's more power to capital, to money, than to the folks who do deals. A few years ago, if you got a great deal, a lot of money was chasing you. You could offer, let's just call them mom and pop terms. Today, most high quality folks, you could actually come to them and negotiate and can tell them, hey, I'll write you a big check. Can you get me better terms? And we do that. We do it all day long. I'm a big guy. People call me Big Mike. I'm 6'4". When I meet them, I step on their toes. Here's a 6'4" guy stepping on your toes pretty hard and saying, listen, before it was an 8 pref, an 80-20 split. Now I need a 10 pref and a 90-10 split, as an example. Now, it's not necessarily always going to work, but I'm going to tell them, listen, I'm writing you a $6 million check versus people writing you a small check. If I don't get those terms, I'm okay to do something else. And that's how the conversation goes. So you have leverage to negotiate better terms too. Don't forget, that's another important element of your investment strategy. It's not like you're buying stock in a stock market. You can't get a 10% discount because the market is the market. Here, if you bring in significant amount of money, you can negotiate.
Right. Yeah. So, I mean, folks would be investing presumably with you through a direct placement, or do you have your construct set up as a fund, or do you do both?
Yeah, we do both. We run funds, but I'll tell you, most of the deals recently, they're syndications. They have their own PPM, private placement memorandum, and there's a lot more interest in direct deals today. People have been really shining away from funds because funds is sort of a little bit of a black box. You can describe the strategy and you know who's the manager, and then the fund manager does his or her own thing. The reason people prefer individual deals is because they really want to get clarity where the investment is at. And there's all kinds of interesting statements. Just give you an example. And we try to be, apolitical. I'm kind of the middle of the road person. I don't like extremes on either side, and I've been in this country for a long time, and I love this country. I'm a U.S. citizen, U.S. patriot. I came here in '89 as political refugee from the Soviet Union. I don't like what communists were doing. I don't like all that. So when I came here, I thought America was great, but we're finding ourselves a little bit, times have got a little different. Where I'm going with this is that we've seen people that tell me, I'll never write a check in California, or I'll never write a check in New York. Don't ever bring me a deal in New York because, of political environment. I say, listen, I understand. So when we work with folks, we need to understand it's not only what they want to invest, but where they're comfortable to invest. So why this is important, because you got to be comfortable with your investment on all dimensions, depending how what you like and what you see. And we've got deals in various parts of the country, and we look at this: is this a great deal? It's really interesting how I would never do a multifamily deal in California or New York, but I would do a commercial deal like an open air shopping plaza in California. We have a deal like this in San Diego, downtown San Diego. Why? Because things are treated very different when it's a commercial versus residential. So things like this matter. It's all I'm going to say, that understanding kind of your own preferences is a starting point. Back to the goals. It's goals and preferences you start with, and then can you connect with the sponsor, operator, strategy, location? Can you get the right terms? And then you can negotiate from there. If you really get to like the deal, the two primary negotiations that I've seen, and just to add one more point on the negotiation, it's the frequency of the investments, programmatic investments. I'll write a check today, I'll write a check tomorrow, a day after tomorrow, right? And then the size, right? If you have any of those things, you have leverage to negotiate better terms. I've seen even people, when they like a deal, they tell me, I'll call my friend, and my friend will write a check, and his friend will write a check. Before you know, they wind up, friends invest together. It's another reason. It's a collective due diligence. You look at the deal, and then you have two other friends look at the deal, and you all can say, do they like it or not? So I've seen that too, where I was at a conference just last couple of days, actually in Houston, with a gentleman out of Silicon Valley. He's an IT, and he's been investing in real estate. And he has a group of other IT guys and girls like him, and they all invest together. They're like an investment club. So you get one on board, suddenly many others look, and before you know, if you get a whole group together.
No, and I think that's also smart. It's like people that like and trust that are investing with you as LPs. they may be asking a lot of questions, good questions from the sponsor or the operator that you didn't think to ask, right? So I did, and to your point earlier, there's probably a little bit of bargaining power too when they're investing as a collective. The same way that you're negotiating with sellers, that could possibly negotiate with you by bringing a bigger check to a particular deal.
Are you someone with a demanding job but tired of the 9-to-5 grind? What if you could build a profitable side hustle without sacrificing your full-time career? Our new partner, Book Profits, can show you how to turn your limited free time into a thriving online business. Learn how to find, sell, and profit from used books all on your schedule from the comfort of your own home. Not crazy tech skills needed and no major upfront investment, just simple strategies that fit into your busy lifestyle. Visit the URL on the screen for a free training today and learn more.
Yeah, exactly. It's don't be shy in this environment. There's no wrong question. There's no bad question. The fact that you're looking at the deal, the fact that you're talking it is already a good sign for them and an opportunity for you. And at the same time, keep an open mind. You may not like this deal, but you may like the next deal, and communicate your requirements of what you like. I've seen people look at these deals as a binary yes or no. Well, yeah, for a given deal, it's a yes or no, but it's also negotiation. It's also, you could ask, listen, I don't like this deal, but I like the following. Do you have something in this market, or it looks like this? Or you're talking about an equity deal. What if is there anything in the medical receivables fund or this or that? Oh, you guys are not offering a fund, but I'm more interested in the fund. So what's really interesting is that connected people might have other folks they can introduce you to. So I was talking to, we had actually, well, in Houston, we had a dinner with a few of our investors, and one of them was asking, hey, do you know anything in the medical space? She's actually a doctor. And I told her we're looking at potential some medical triple net leases. So like a surgery center could be triple net leased to real estate. Basically, a hospital could sell the center and then lease it back and sign 20-year lease. So it could be very predictable. So we're looking at specific strategies, but also she said, do you have anything else besides real estate? So I know a friend who runs the medical receivables fund. I said, I'll introduce you to my friend. So part of the conversation is just to see what could be a match. Again, I don't know what's a match. Sometimes, I have this really important thought, and I've said this multiple times on my own podcast, and I continue to say this as a guest. You got to have your own buy box and your don't buy box. So your buy box is what you really want. And the fact that you know what you don't want is just as important as you know what you want. Because sometimes you don't know what you want, but you really know what you don't want. So how you can do this? Well, my don't buy box is pretty much any ground up development, redevelopment, any other speculation where my downside is not well protected. There's a lot of risk associated with construction. There's difficult to get a discount, and I don't want to speculate on what the future rent's going to look like or the future price is going to look like. I would rather get a deal today, but not all income deals going to be interested. People talk to me about oil and gas, and I tell them, listen, I'm not going to do oil and gas because I don't like, for example, how there's no return of principal. All your cash flows have to be so strong that you get your principal amortized over the payment of the first few years of the production. So all the deals I've looked at, I couldn't find it. So I'm not against oil and gas at all. I couldn't find the right type of returns with predictability of cash flows. Also, I vividly remember what happened when the oil price spiked. I was in 2015. I remember investing in a publicly traded ticker, VNR, Vanguard Natural Resources. It was distributing 15 to 18% yield when the oil price was $100 a barrel. When the price collapsed to like $40 a barrel, the thing went bankrupt. So I'm a little bit of that, volatility can be pretty high in energy sector. So as long as you can find the right type of deal and it fits your box, is fine. But to me, it's in the don't buy box. So knowing your buy and don't buy box is very important for the reasons of whenever you see a deal, if it's outside of your buy box. Oh, I just got an email today from somebody who met me at a conference a few years ago, and they said they're in Boston area and they're buying some liens on condo association liens. I don't know exactly. And immediately my immediate reaction was going to be highly unlikely. This is not going to be in my buy box, because you got to buy liens, means you're not cash flowing from day one. You got to know local dynamics, local laws, right? So I'll have a quick conversation and try to understand what kind of risk, what kind of return profile, how they're secured, just to learn a little bit about the strategy. But at the same time, to me today, I have to establish high confident value and feel there is great cash flow and conservative leverage. Then I can transact, because I know my buy box pretty well. I also know my don't box pretty well. It's easy to see if it fits or it doesn't fit. That's simple.
Right. Yeah, and I think a lot of that ties in with, you can't be good at 10 different things. And even if you're investing through a third party, if you really are very selective about the types of deals that you're looking at, you can also be really selective about the operators who know those types of deals. So you know really good questions to ask about that, rather than spreading your time across 10 different types of deal constructs. So I think that's just generally good advice. I also like your advice about protecting from downside, right? Like a lot of people, they underwrite things, and everybody can get rich in Excel. It's great to be able to see the numbers go up on a spreadsheet, but what implicit assumptions are you making about that, and what happens if the market goes down? How are you making sure that you're protecting yourself either through non-recourse debt financing or something like that? So those are all important things that people should be thinking about just generally.
Yeah, this is a great thinking, exactly what you're saying. So when you're investing, I've seen even this, right? So people invest in debt funds, first lien lending, hard money lending funds, private credit, right? Banks stepped out, people use lending funds to get current income. It's probably one of the simplest conservative investment strategies to get yield. People get 9 to 11%, let's just use an example, in hard money lending. But one of the most basic questions people don't ask, do you have leverage in your fund? And when you find out, yes, they have leverage, you're suddenly not in a first position, you're in a secondary position. What if some of these loans not done well, and then there's a defaults, and then all kinds of issues start popping up, even in a conservative lending strategy where you are most senior on a capital stack. When you invest in equity, it's even more relevant. Actually, low leverage in both on debt and equity side create more conservative investing. If you are a lender, you want lower leverage. And if you are an equity investor, you want lower leverage to create effectively lower level of risk for both, for the lender and for the equity investors. And there's no right or wrong how much leverage is good and how much leverage is not. But conservative leverage has always been 60-65%. If you're sub 60, you're generally pretty conservative. If you're going over 65% on leverage, it's not that you're taking too much risk, but you're reducing your downside protection. And what's really amazing is when you can get great returns and low leverage. So that means you're really getting into a deep value deal, because you don't need to make a crazy return or strong return without higher leverage. You could certainly make it like a bandit with high leverage, but you took a lot of risk. So this is very important. So you really have to think about risk, and risk is not easy to assess. This is one of the most difficult things to do, but leverage is one of the elements of risk. Two, obviously, what kind of strategy, who you're investing with, and how they make money. It takes experience, exactly what you said. If you don't have deep expertise, if you have not developed the expertise, right, you cannot be, you are an executive, at a, I don't know, airplane leasing shop, right? You buy airplanes, you lease airplanes, you're wonderful at that. But now you're trying to invest in real estate. A lot of the finance terms are probably similar and clear, and you can understand that. But you may not know some of the underwater stones of specific strategies, right? So, oil and gas stations, it's real estate. But then there is pollution, there's ground tests, there's some complexity related to environmental. The best way you basically mitigate is that you diversify, You can't beat diversification as a mitigation strategy. You just don't know. And then you start investing and you start learning from your own, you start observing. You got to start somewhere. So write one check, and then because real estate moves slow, you can't really see the full cycle fast enough, right? So it takes 5 years or 4 years for a cycle. But what you can see is you invested your money today and see what happens in 3 months. Did you get a distribution on time? Did you get your reports on time? How your questions are answered? So you continue to learn as you go along, and you continue to see who you want to work with more and who you want to work with less as part of the whole story. It's almost impossible to know for sure from the get-go, right? This is not you buying J.P. Morgan Chase stock, or you're buying Google stock, or it's different. It's just because it's private and it moves slow, but you got to keep learning from your own investments by observing how they perform and how the people who you invested with respond, operate, etc.
Yeah. Well, hey, Mike, we could probably talk about this for 3 hours, both seasoned real estate guys, but I appreciate you being on the show. I'd love for you to be able to share any information about how people can get in contact with you, or, just learn more about what you're doing.
Sure. So fairly easy to remember. We have a corporate website, but I never give people a corporate website because it's an easy to remember website. So I give them the cheesy. Again, I run a podcast, Big Mike Fund podcast. It's a cheesy name, but I'm 6'4". I'm a big guy and fund manager. It's stuck. So bigmikefund.com. It's an entry point. You could listen to the podcast if you're bored. You got nothing else to listen to, or you want to learn a little bit about real estate. I do have some cool guests, really smart cats. And if you mistype it and you go to bigmikefund.com, you forget the D at the end. I promise it's not a kinky site.
Well, thanks for being on the show today, Mike. Appreciate the time.
Thank you, Bryan.